the honor to have Sugheson Nagarajan, who is an economist at the Bank Negara Malaysia. So he gonna present today his paper on the threshold effect of government debt in Malaysia. So as usual, you have like 1 hour. Feel free to ask questions whenever you want, and the floor is yours. Thank you very much, and go ahead.
Thank you, Augustine. Good morning, everyone. Thank you for joining us today. My name is Sugheson Nagarajan, I'm an economist from Bank Negara Malaysia. So today we'll be discussing the working paper which was co-authored by myself and my colleagues Muhammad Helmi and Muhammad Shahir, who are unfortunately unable to join us today, as well as our external collaborator, Dr. Evan Lau, who is an associate professor in University of Malaysia, Sarawak. And all of my collaborators are unfortunately not able to join us today. So I'm bringing us through the working paper. So the paper that we are looking at today will be on, does the threshold effect of government debt on growth exist for Malaysia? Next slide, please. Yeah. Maybe just give a moment if I want to step it down a little bit. So thank you everyone for joining. So we just started actually. So on slide number 2, we are looking at this as an introduction as well as a context setting for the motivation of the paper. We look at the evolution of global government debt, which has been on a rising trend since the 1970s. And this increase has been driven by higher government expenditure on key public investments, as well as policy responses against economic shocks. Notable ones, at least more recently, would have been the global financial crisis in 2008-2009, where the global government debt increased from 64.3% to 71.9%. And most recently, the COVID-19 pandemic, where global government debt increased from 84.9% to 100.4% in 2020, from 2019 to 2020. But of course, in 2020, there was a gradual decline back to 92.4% due to favorable macroeconomic conditions, namely being the rebound in GDP, as well as the elevated inflation during the year. But these historically high levels of government debt has set off warning bells among policymakers on the risks involved with higher government debt on growth, especially during a period where interest rates are high and global growth prospects are weaker, and there's a risk of financial stability as well. So that was more on the global context. In the next slide, we shift towards domestic context. Here we can look at Malaysian government debt, which also has been on a rising trajectory from 1997, where we can see that debt has increased from 31.9% in 1997 at the onset of the Asian financial crisis, and it has increased to 60.4% in 2022. So this period of about 20-something odd years is a period characterized by persistent fiscal deficits amidst low revenue collection as well as high expenditure. In that same period, government debt grew faster with a compound annual growth rate of 10%, compared to nominal GDP growth, which was at 7% in the period between 1997 to 2022. So just a little bit more context, we go back a little bit more. We can look at the evolution of government debt in Malaysia, can be seen in sort of 3 phases, where the first phase was a period of elevated debt in the early 1980s due to adverse growth shocks from commodity price downturn and sizable fiscal deficits because Malaysia's revenue was forthcoming because it's a highly commodity-dependent economy. The second phase, after the mid-1980s, is seen as a period of debt decumulation, where we benefited from a high growth environment, fiscal consolidation efforts that were facilitated by the large-scale privatization program undertaken by the government. So the combination of these factors helped us to decumulate debt right up until 1997, where we see the Asian financial crisis occurs. And then from then onwards, we look at it as a phase of accumulation of debt during crisis years, and subsequent consolidation efforts that takes place tends to be disrupted by another crisis. So for example, in 2008, global financial crisis, and in 2000, 2020, the COVID-19 crisis, where the government debt increased by 10 percentage points between those years, showing that there was a fiscal policy response to mitigate against the adverse shocks that experienced by the economy. So if we zoom more closely into the COVID-19 era, we can look. Sorry. Yeah.
Sorry, it seems that you're saying that during the crisis it has been increasing a lot as a response of fiscal stimulus, no?
Yes.
But I mean, it doesn't seem the case, like neither during the COVID crisis or neither during the global financial crisis, that increased that much. It has been increasing like a little bit, but every year. Like if you look at Philippines, for example, during the COVID-19, they increased like 18, 20% of GDP. Like Malaysia increased how much? Like 1, 2%?
About 10 percentage points only between those 2 years. 2019 to 2021, it increased from 52.4% to 63.4%.
But then
I think it's not so obvious in this chart because we scale it back to 1980s where we had due to the scale of the chart. So on the left-hand side, you can see that it's up until 140, right? 140% of GDP. But if we were to look at more recent example, if you were to zoom, I think the difference will be more visible.
Sorry, then I don't understand because what you're saying then is not what this chart is saying.
Yeah, this chart is saying that actually. So you can see that from 2019 to 2021, we jumped from 52.4% to 63.4%.
If I'm not blind, it says 62, no, 52.
I think that is for 2020. 2019 is not labeled there,
okay,
unfortunately. But the jump doesn't look so stark because of the scale of the chart.
Okay.
I think if the scale of the chart was resized, the jump would be more apparent.
Okay, so 2019 is a 52.
Yeah, 52.4%.
Okay.
Yeah, it's not labeled there.
Okay.
Unfortunately. Yeah. But it's just to say that at least since the Asian financial crisis, we have undertaken fiscal spending to get us out of the recession or the adverse shocks. And we were not able to sort of decumulate debt to the pre-crisis levels because before we could even reach those levels, there's another crisis. So 1997, fiscal consolidation efforts begin, disrupted by GFC. After GFC, we undertake fiscal consolidation efforts, then we're disrupted by a COVID-19 crisis. So that's the sort of the messaging of the chart here. Yeah. So that sort of gives the overall. Sorry.
For the earlier part, this is just like for my knowledge. You pitch this as there was good debt accumulation because there was unfavorable economic conditions. But from my limited knowledge, there was also a period of high government investment, right, with the new economic policy from
Yes.
1990.
Yes.
So it might not only have been just unfavorable economic conditions, but actually a deliberate accumulation of debt to really address the structural changes of the economy.
Yes, yes. So the early 1980s could also be described as that as well, because there was a lot of activist government policies in terms of trying to incur debt and boost growth, especially as you mentioned with the inception of the new economic policy as well. So yes, yeah. Perhaps next slide. So given the backdrop of what we have just seen, we sort of explore the theoretical underpinnings of the impact of government debt on economic growth. So this is a key policy question that can be traced back up to the 1940s. And there's a saying that when it comes to debt, the dose makes the poison. So the main premise here is to suggest that there is a non-linear concave relationship between these two variables. So as you can see on the chart, between point A to point B, additional government debt accumulation improves growth dynamism or growth. And then from point B to point C, the marginal impact of this additional debt starts to diminish. And this peaks at point C, and point C onwards, the marginal impact of additional debt towards growth starts to become negative. So there's still positive growth, but it's becoming lesser. And at point D onwards, the additional debt has a negative impact to growth. That is the sort of the conceptual framing of how people think about the relationship between government debt and its impact to economic growth. So knowing these thresholds is vital for policymakers in a sense that once we do know these thresholds, it makes it easier for policymakers to sort of balance the trade-offs between the benefits and costs of incurring higher debt.
So what is the mechanism behind increasing debt, increasing growth? How does, I couldn't see that relationship. I'm not really in this field particularly, but how does government debt actually increase growth?
Oh, there are several channels here actually, but if so one straightforward obvious way would be that if we look at it from government borrowing to finance development expenditure is one. Second is government issuing debt to borrow money is also a way of deepening the financial markets. Therefore, it sort of sets the benchmark yield and gets private sector players to be more active in the financial markets, and therefore the allocation of resources to sectors that need it, so that it makes the financial market more robust and dynamic. So that's another channel. But I'm just wondering if I have some of my notes here that sort of captures this.
What's the negative?
Negative is also
the
crowding.
the negative, we will look at it the next slide.
Okay.
So the next slide sort of talks about the transmission channels. Yeah. So next slide, please. Yeah. So since the GFC, obviously there has been a renewed interest in the relationship between government debt or public debt and growth, thanks to the seminal Reinhard-Rogoff paper. But economists have long theorized about the various channels where the long run, how long run impacts of government debt to growth. So I've tried to summarize this in the paper. Obviously, there are many channels and these channels are interwoven with one another, but I try to summarize it in a simplified manner. So I think we can look at it in 5 ways. One is uncertainty, where when government debt is high and there's uncertainty about fiscal policy conduct, that can distort consumption and investment behavior. It can increase precautionary savings. So that's one way. Second is the potential for higher taxes to fund future liabilities, which also can distort consumption and investment behaviors. Third is higher debt from increased spending, which is inflationary as well, can distort this consumption investment behavior, as well as induce higher uncertainty in fiscal policy conduct. Then we can look at the crowding out effect as well, where higher government debt causes higher interest rate, thus lowering capital accumulation, as well as reducing the competitiveness of net exports. So that's one more channel. And lastly, higher government debt entails higher debt service payments as well, which takes away from other potential spending, so less fiscal space available for other productive or growth enhancing expenditure, therefore resulting in lower economic growth.
So my question here is that, do you account for political factors? Because most of the time, in terms of government taking expenditure, a lot of it is driven by political cycles. Do you account for?
In the paper, we do not do that, but I think the literature is quite well established as well on that front as well. Yeah, but the budgetary cycles sort of coincide with the political cycle as well. But yeah. So, but just also to quickly add another point that is not really on the slide, but to be fair, economists have also argued otherwise, to say that actually, even when you have high government debt, incurring additional debt can still be positive for the economy. And those there are certain caveats or conditions to that. So one notable one being Blanchard, where he says that debt levels is not a big concern as long as interest rates on the debt remains below economic growth rates, which is a condition that no longer holds, unfortunately. Others have argued that higher government debt, the impact on growth depends on whether it is used for operating expenditure or capital expenditure. And people have also argued that even when debt levels are high, if we're operating in an economic condition where we're in deep recession and there's constrained monetary policy, then incurring additional debt can yield positive fiscal multipliers that can improve current and potential output as well. So in those scenarios, specific scenarios, still incurring additional debt can still be useful to positively impacting growth. Yeah. So with that being said, next slide, please. Against this backdrop, the motivation of this paper is the aim of the paper is to contribute to this trend of literature by examining the existence of a non-linear relationship between government debt and economic growth for Malaysia. And we do this using 2 methodologies. So on slide number 6 here, we have shown the first methodology that we're using, which is a threshold autoregressive model based on Hansen 2000. This methodology is based on OLS regression model with dummies, where the threshold is measured by the value of debt ratio that minimizes the residual sum of squares. And essentially what we do here is to compare the null hypothesis of no threshold against the alternative of single or dual thresholds. And then we are able to internally compute what those thresholds would be.
Question, just going back to a question, like, why looking at the effect on public debt on growth and not looking at the effect of public investment on growth? Because at the end of the day, what determines growth is these infrastructure projects or development projects, not debt by itself. Debt is only a way to finance a project. And actually, there is a lot of literature that show a negative correlation between high levels of debt and economic growth. So why do you think that debt and growth should be directly related? They are only related as long as you are using debt to finance projects that might contribute to growth, no?
Agree. So the relationship between debt to growth depends on what the debt is used for, right? We agree on that. But there is still some merit to studying debt, the ratio of debt to growth, just from a policy perspective as well, where it can help you formulate or at least have some form of safeguards if you have a general sense of what is the threshold debt level that you should be aware of, even if it's not really operationalized into fiscal rules per se, but it sort of gives perhaps a soft constraint on what policymakers can think of as this limit that we should try not to cross. So that is more of a policymaking perspective. But if you're looking at economic channels, right, from a purely academic perspective, then I will concur to your points made. We should be looking at how this debt is used, and hopefully that will be scope for further research for us.
But then the threshold is not about going to contribute to growth or not. It's about if it's below some threshold, it's sustainable. If it's above that threshold, then become unsustainable, no?
That is a simplified way of looking at it, but we do sort of provide caveats against those type of interpretations because we do understand that it's not sometimes as straightforward as that, but it's again more so to act as the soft constraint that at least you have this. I'm going to jump the gun here, but if we can compare it to speed limits, if I go if I go at 60 kilometers per hour, it's not like I'm going to be safe, and 61 kilometers I will crash. But to sort of map that theoretical notion of vulnerable regions to bad outcomes, I need to define a threshold. So that is where the merit of having threshold comes in.
Okay.
Yeah.
So this study is about where are these regions,
Yes.
but then it has nothing to do with growth.
So above that particular threshold, then you're more likely to adverse growth negatively.
Okay.
Yeah, that's where the link comes in.
So my question here is that the threshold, you're trying to find where is it, right?
Mm-hmm.
Does it changes across time and place and location? And what are the factors that you think determines this threshold value?
I could answer that question now, but we are going to look into that as well later. So you're right, this threshold does not need to be fixed, but most studies tend to take panel data estimates, so it accounts for a long time horizon.
Okay.
And but what we try to do is we have tried to look for country specific. We try to look only for Malaysia alone, and we are trying to use it for our period between 1980 to 2022. That's our data set. So we cannot say for certainty that this will apply for the future. That's one. Second, there are a multitude of factors that can affect. One is the structural factors, structural setup of the economy, the maturity and the depth of the financial markets, the development levels of the countries. And so there are a few things that we've highlighted in our paper. I can't quickly recall some of them off the top of my mind, but yes, those things do affect where the thresholds will sit. Okay. Just to give a quick comparison as well. So the number that we've came up with is actually quite slightly higher compared to most literature on emerging markets and developing economies. And we think of that because Malaysia has yielded very robust growth performances in the past 20, 30 years. And also we have a very strong financial market. So those are the reasons for potentially.
So you're saying that we should spend more and take more debt?
Oh, no. But we'll get to that later. And also, if any of you expressed it as completely mine and does not reflect Bank Negara Malaysia, right? let's get that out of the way. So, yeah, the next slide, please. Yeah. So, this is our second methodology that we use, which is a debt augmented growth model. For this method, we first use an error correction model to estimate, to confirm the long-run relationship between government debt and economic growth. And once we confirm this relationship, we estimate the debt augmented growth model. And we use this to test for whether there is a non-linear and concave relationship. And then we use the coefficients of the debt terms to compute the threshold at which additional debt causes negative impact to growth. For this particular methodology. And then the set of controls are selected based on established determinants of growth in the literature, in the relevant literature. So one example is Wu and Kumar 2010, and a few others as well. So these are the two methodologies that they've used. And the reason of using two methodologies is also because we wanted to have a range rather than one singular number, because we know how contested the idea of debt thresholds have become since Reinhardt and Rogoff. And we didn't want to further that sort of narrative. So we give it the range, then we can make more, we can have more room for interpretation, making sense of the numbers that we obtain. Yeah.
But one quick question on this one. So inflation and net export, I can see why they belong as controls. Like population, if you're comparing things across countries, yes, that's the driver of growth. But if you're doing this analysis within countries, what is the rationale for including population? Because population, in a way, it's like it's increasing, but there's not going to be the same kind of variation affecting GDP at the country level.
Right. If I'm not mistaken, the rationale was that it was used as a proxy for human capital. Yeah, and then we sort of benched against what other literatures that are doing. Of course, the challenge for us here was that a lot of the literature, the well-established ones, were looking at panel data, so cross-country assessments, whilst the number for studies that's looking country-specific was limited. So then we had to work around those limitations. Yeah.
I mean, but if you look at the drivers of growth, like I also don't see investment, and I don't see some variables that might be like very important for growth, no?
Yeah.
Why you're choosing these independent variables?
So these were selected based on what we consider to be determinants of growth that were in the literature, and also because they were able to provide us with statistically significant and meaningful results. So there were some limitations around public investment data that we had to work around. So, given those constraints, so this was the model that we chose in collaboration with our external academic as well. So our collaborators as well. So we had to discuss on what we can do to work around those limitations. But yeah, we do see that those type of data or those variables can be seen as important variables actually. But unfortunately,
because I feel that it should be easier for you to get data than studies that have cross-country analysis, because you only need to get the data for one country. So for human capital, for infrastructure investment, like I'm pretty sure there is Malaysia data. So I mean, it seems like if you show me that that is significant correlated with GDP, I don't believe you, just because you are missing a lot of control variables that are relevant in the growth literature.
Right. Fair enough. But perhaps that is something that we can also work on further to enhance this research, since it's still at a working paper stage, and we are looking at for suggestions from everyone to sort of what we can do to enhance this. But yeah.
But in general, more broadly, again, I don't know macro at all. Where does identification come from in these types of research? Or is the goal really just to find the correlations?
What do you mean by identification?
Like, how do you establish causality, the causal relationship between debt and GDP,
right,
as opposed to just like estimating the correlation?
Yeah. So in macroeconomics in general, establishing causality is extremely difficult.
Right.
So usually we rely on certain tests that we use it for, but it's very difficult for us to establish for certainty to say that the X causes Y, and that is pretty much prevalent across all macroeconomic variables, to be fair. But yeah, so in this research we use a Granger causality test and a few other tests, if I'm not mistaken, but I can't quickly recall. But those we were able to yield statistically significant results for those. So we were comforted by that.
But then something, so like this approach is well accepted in this literature, like including, let's say, the Reinhard Rogoff paper also, like, does this type of analysis.
So because Reinhard Rogoff is panel data, they don't specifically use this, but for a lot of papers that are looking at country specific, the debt augmented growth model is the popular choice. So we can go to the next slide and just have a quick sip of water.
Can online ask question?
Please go ahead.
Okay, I just wonder why you use Hansen because in this kind of empirical work, especially economic growth, endogeneity is a big problem, and I think someone raised the issue of causality. I'm just curious why you don't use the structural threshold regression by Cortellos, Stagnos, and also Tan. They publish in econometric theory, so that would be more appropriate if endogeneity is a big issue lah. So that is a refinement of the method by Hansen, the method by Karner and Hansen. So I'm just curious why you still stick to Hansen old method in 2000.
All right, thank you, Ken Ping. Can you just repeat the test that you mentioned earlier? Sorry, structural threshold
regression. That was a paper in I think 2015 or 2016, published in Cambridge University Press, econometric theory. So you might want to refer to that paper.
Yeah, we will definitely try to incorporate this comment. So thank you for the comment. But if I could just briefly answer your question on why we went with Hansen, it's also because that one of the collaborators that we worked with, he has had experience using this methodology, and therefore he felt comfortable with that. So as an initial starting step, we went with that particular methodology. But we take note of your comment. Thank you very much. Yeah. So perhaps the next slide, slide number 8. Yeah. So this slide presents us with the results from both methodologies. So in summary, the estimated debt threshold ranges between 70 to 74% at the lower bound, while the upper bound estimates range between 97% to 103% of GDP. So for the threshold autoregressive model, when we compare the null hypothesis of no threshold against single and dual threshold, the result yielded dual threshold. And then the figure of the threshold that was yielded was 74% and 97% respectively. So which means that within the, so any debt impacts growth positively below 74% of GDP, and it affects debt negatively above 97% of GDP. And similarly, we look at the debt augmented growth model, we get around similar number, 74% at the lower bound and 103% at the upper bound. And we further analyze it using the estimated error correction model. And we find that the inverted U-shaped relationship holds between government debt and growth. And the debt threshold that was estimated was 71% of GDP. So given these results that we have gotten, the conservative interpretation based on the lower bound estimate would suggest that government debt has a positive impact on growth below 70%, and anything above 70% is potentially affecting growth negatively. Now, I think we touched on this upon earlier. So the range between the lower bound and upper bound, how can we interpret this? Is that it can be considered to be a gray area, which reflects the difficulty of mapping the concept of vulnerable region to bad outcomes. So this is where we take a sort of a more nuanced position, where we don't say that, oh, after 70%, you're going to have bad effects to your growth. But we should be wary that once you're above 70%, you are now entering into these regions where you can additional debt accumulation may not necessarily immediately impact growth negatively, but that particular trajectory may then, if you proceed further in the trajectory of increasing your debt beyond that point, may negatively impact your growth at some point after that. So that is sort of the conservative and nuanced interpretation of our results. And as I mentioned this before, this goes back to the whole speed limit example that I used earlier. It doesn't make sense to say that at 69% of debt, your impact to growth is positive, and at 71% the impact is negative. Therefore, that's why we've gone with the concept of ranges, lah. Yeah. And these results give us some. Oh, sorry.
Can you finish?
No, I think I'm done with this actually. Yeah.
So my question here is that how do you think the relationship is also there's some sort of like reverse causality issue where, for example, you drive over the limit, right? So you drive a car in a highway, and suddenly you see that you're over the limit because there's a camera, and you slow down, right? So the idea here is that if you go 74%, the public policy people are going to say they're going to have alarm bells ringing, and then they're going to decrease their debt, right?
Yeah.
So could it be driven by that sort of result as well?
Yes, though in the paper we don't explore those things, but I think the literature is well established about how market dynamics can change rapidly.
Okay.
So it's about investor perception, especially particular for emerging market developing economies, because we're so sensitive to perception and investor confidence. So sometimes what was stable today can be unstable tomorrow just because investor appetite has changed, or their perception or their confidence in the government's ability to repay their debt has changed. So yeah, that definitely does play a role as well.
And a follow-up question on that. What is the role, for example, that play the debt rule that Malaysia has? If I don't remember wrong, there is a debt rule that the government cannot be above 60 or 65?
Yes, 60%, yeah.
So basically 60 or 65?
So
60 coming soon, 65 was the past limit, essentially.
yeah.
So right now, what's the rule, 60 or 65?
It's unclear because we want to reach 60 by a certain
Okay,
time.
so right now it's 65.
We can go at 60% because of the new Fiscal Responsibility Act.
Okay.
That's the latest one now. Yeah.
Okay. I mean, because what I was about to say is that it doesn't matter if the threshold is say that is 70, like if you're already above the rule, that also can have an impact on the investment perception.
100%. So if you have a limit at 60% and you're operating above it for a sustained period of time without any reversion in fiscal trajectory, that can hurt in investor confidence and just overall general confidence in the economy and the government as well. Yeah.
And for example, just if you want to incorporate this investment perception into analysis, why you're not using data for sovereign spreads or ratings like Moody, these ratings, why you're not using that to try to control for this investment perception or sovereign risk?
I think we can do that, but for specifically for this particular methodology and the literature, those variables are not necessarily seen as determinants of growth.
I mean, but you're looking at the literature from the 40s. There are like many new things, and with the data that we have, we know that especially for emerging economies, spreads, interest rates are very sensitive to increasing in debt. That is not true for the US or advanced economies, but for emerging economies, they are very, very volatile interest rates. So I mean, saying that some literature is doing that is not exactly the right answer if you want to do a serious analysis, no?
Yeah. I think we sort of do address some of these type of queries in the next slide, actually. Maybe we can go to the next slide. So just quickly, for central bankers, policy implication is like a big thing for us. So what can we sort of inform policy conduct based on these results? So there are
Quickly, in terms of that, it's fiscal policy, right? So it's not under Bank Negara's.
Oh, yeah, it's not. But we do conduct advisory role to the government, and sometimes that involves advising on fiscal matters as well, though we do that with extreme restraint. Yeah. So some key policy implications. First of all, I think as Augustine has already rightly pointed out, currently our government debt as of 2023 is at 64% of GDP, and it's below the threshold that we've identified, 70%. So this means two things. It's mostly good news. One is that the government has fiscal space to increase spending in terms if there's a crisis that occurs. They have that fiscal space to expand fiscal spending without adversely affecting, without worrying about growth too immediately. So that is one positive side of the implication. On the second one is that we can look at the FRA debt threshold, the Fiscal Responsibility Act, which says that government medium-term debt level should be 60%. And it sort of acts as, we see that as an appropriate target because it is in line with other peers of similar development status, as well as if your threshold is at 70%, but you've set your fiscal rule at 60%, it sort of gives you the buffer to expand your expenditure without really immediately worrying yourself about the consequences towards growth yet. So that might be useful in terms of rebuilding fiscal buffers. The next policy implication is on fiscal risks, where this is where we sort of move away from the fixation with debt, which is quite in line with how the literature has developed since Reinhardt and Rogoff in 2010. So essentially what they're trying to say here is that while government debt ratio is still below the threshold, that does not mean there are no other fiscal risk that can impact growth. And this can come, for instance, an example is like in Malaysia's case, we have low revenue collection, which is less than 15% of GDP, and we have high expenditure commitments. About 50% of our operating expenditure goes to locked expenditures, things like emoluments, debt service charges, and pension. And these type of characteristics of your fiscal conduct or your fiscal policy levels can limit your ability to undertake productive and growth enhancing expenditure, the type of expenditure that's really needed for the government, and that can have implication towards growth as well. And thirdly, this is where we look at debt sustainability in and of itself. So again, in the spirit of trying to move away from the, for lack of a better word, obsession with debt thresholds, a lot of the current analysts tend to look at the composition and structure of debt itself. And one of those things that they look at is debt trajectory and debt structure. So for example, Pescatory 2014, in their assessment, they were able to show that countries that have high government debt to GDP ratio can still enjoy sustained economic growth as long as they're on a downward trajectory. So the trajectory of debt matters. And some of the channels that they have identified in their paper was the channel through confidence. Because as long as investors see that you are doing something to moderate your debt, that can be perceived as you're on good fiscal trajectory, and therefore the negative impacts are not there yet.
It could be bad as well, because the moment you start doing something, it means something is wrong as well.
Sorry?
So it could be that investor perception can change in a sense where if you do something like a law or something, that means things are really dire and bad.
Yeah.
It could also be true as well. So
yes, yeah, definitely, because then I mean, the sense of urgency that it imposes.
Yeah.
And then maybe if we can also draw to the debt sustainability analysis framework that is employed by IMF and World Bank together as well, where there's more emphasis on composition of debt, where they look at things like proportion of foreign currency debt, average maturity, financing requirement, distribution of debt, government debt between resident and non-resident. So they use this analysis to sort of identify pockets of vulnerability and how those pockets of vulnerabilities can then affect growth, which is more of a micro-esque type of assessment, not really a macro level assessment, but you are better able to sort of discern the channels in which debt can pose a risk to growth. Sort of moving away from a more of a macro concept that comes to debt thresholds, we just looks at, okay, this is a particular threshold, anything beyond that is going to affect growth. As I mentioned before already, the literature has grown to become more critical of the concept of debt thresholds, but policymakers and to some extent academics also do see some merit in it to the extent that it acts as a soft constraint. Yeah, and with that being said, I think the last slide is just a summary of what we've recaptured so far. First one being that Malaysian government debt has been on a rising trajectory. Hopefully with the FRA, we will be able to moderate this debt, currently standing at 64%. And by the medium term, we can bring it down below 60%. I think the fiscal consolidation efforts for those are underway, and we hope that it materializes. Second is that the finding of our estimates, we see that it ranges between 70% to 74%, the lower bound, while the upper bound ranges between 97% to 103%. So a conservative interpretation takes the lower bound estimates. And last but not least, I think the findings, we try to underscore the more dynamic interplay between government debt and economic growth, so that we pay more attention to just not the level of government debt ratio alone, but we also pay attention to things like other fiscal risk and debt sustainability assessment. And that concludes my presentation. Thank you everyone for your questions and opportunities.
Thank you very much. We still have 15 minutes, so feel free to ask. Otherwise, I have like 55 minutes of questions.
Yeah.
Government debt, is it central government debt?
This is central government debt. So in Malaysia, we will call it federal government debt. So this debt does not include state government debt. It does not include government-linked company debt as well. So it's just federal government debt.
Is it possible to get into that debt?
State government debts are actually quite difficult to obtain because the publication regularity and standards are not very well aligned. Also because Malaysia as a country is very centralized.
Yeah.
So the federalism is very centralized. And yeah, so for that reason, that's why there's this discrepancy. So, but it is possible, but it will be much more tedious in terms of data collection.
I think that the total debt itself should be set in totality. When you use the central government debt, you're trying to underestimate part of the debt. But sometimes even the domestic debt can trigger default. Sometimes even though it's less risky. Yeah, so if in future, that is something that was interesting. See this aggregator.
Agree. But more on a perhaps a policy aspect answer is that there are certain administrative controls that the federal government has over state government expenditure. So if a state government wants to borrow to do XYZ, I believe they must get permission from the federal government, especially if it's a huge sum of loan that they're borrowing or whatever. And federal government must approve it before the state government can then issue bonds. So in that sense, federal government still has a sort of like a tight supervisory role to play here to ensure that the state governments are not getting into debt that they cannot manage. So that's one angle this controls comes in. But yeah, in terms of assessment for our purposes, it will be much more helpful to have more comprehensive view about the total debt stock as well.
So are you also interested in adjustment of the debt? Because in aviation, you're interested in what happens. Then adjustment back to debt optimal ratio.
You mean what happens to growth performance when
Debt ratio deviates from the optimal. Are you interested in also looking at what happens if you reverse? How fast if you reverse back?
I am interested, but as of now, I neither have the capacity but this could be a scope for future research as well, especially for our team, which at Central Bank, we look at public sector affairs. So one of the things that we do look at is fiscal sustainability to sort of like push the knowledge frontier and our understanding. So that's definitely something that we can look to explore as well. Yeah. MTA. I see. Take note of that as well.
From this, from other within country studies, how do these numbers compare?
Or compared to other countries?
Compared to other countries?
Oh.
So this goes back to the initial question. Does this vary by time, by place? This is out of curiosity. Because I remember that 80% number from the Reinhard paper, right? But
yes.
This is very much in line with that. But is this true for other countries as well? And if not, what are the sort of factors that affect this thresholds?
Right. So I do have some notes on that here, but I can't seem to quickly recall it. Just give me one moment, yeah. So we have some that are for advanced economies. So for advanced economies, like you said, it ranges quite high. Like Reinhard Rogoff was 90%, Ghosh et al. Was 90 to 100%, and Afonso was 80%, etc.
That's from panel regression.
Yeah, pan regression, advanced economics. For country specific?
Yeah.
For country specific, I believe we have several that looks at, for example, we have, sorry. We have some that looks at North Macedonia. I'm not sure if I'm pronouncing his name right, but Joseph et al., which is way lower at 30% of GDP. Then we have one from Zimbabwe, which is 45% to 50%. And then there's one for Nepal, estimated by Bata and Mishra in 2020, which is estimated for 33%. For Malaysia, some people have done this threshold regression as well. So there's Hui et al. 2017. They found it to be at 37%, but this is specifically for domestic debt alone. So debt issued in a domestic currency. And then there's another paper by Lau et al., which he studies external debt threshold. So that refers to both public and private debt owed to non-residents, and the estimate that he comes with is 78.1%.
So let me ask a follow-up item. Since you mentioned about where I'm from. So I know that they historically maintain very low debt to GDP ratio. Again, like it might be a stupid question, but conceptually, in these types of models, when you're doing within country estimates, you are estimating some sort of a local optimum, right?
Yes.
It's based on the data you have, because Malaysia has had debt levels from 30% to 100%. You don't know if that's the global optimum. Maybe the global optimum is at 100%. Is that true?
100%, yes. Yeah.
But my question here is sort of related as well, because a lot of developing countries don't want to borrow as much, for example, because of the investor confidence. But they're the ones who would want to borrow a lot, right? Because to do positive growth like infrastructure development. So we used to have very high debt in the 80s, right? So a lot of the developing countries would also have the same ambitions as well.
Mm-hmm.
So how does your findings square? I mean, how does the findings of all these threshold figures square with the growth objective of developing countries?
That's a tough question, actually, because I don't think I have actually given enough. I mean, in the past, I've given enough thought to how we can square this. But I think it sort of also comes down to having a more nuanced understanding of government debt. And that has a lot to do with how we think about what this debt is being used for, right?
Mm-hmm.
So a lot of times when we speak of debt, everyone, at least in non-academic circle, at least maybe not among policy experts, but in mainstream discourse, is that maybe everyone tends to sort of freak out about debt, or they tend to speak about debt only in terms of the absolute figure, either in the currency or in the ratio. And then there's a whole lot of panic to it as well. But what really matters is actually, as we've already discussed before, is what this debt is being used for. And perhaps in Malaysia's case, at least, during the 1980s, it's actually one of our constitutional fiscal rules that we are borrowing funds only for development purposes.
Mm-hmm.
Of course, the constitution does not specify what development purposes are, but this type of administrative control has been useful for Malaysia, at least, in sort of making sure that the money that we are borrowing from the markets is really going into things that can improve the productive potential of the economy. So infrastructure, healthcare, education. So even the way we present if you look at the annual budget, the way we present our fiscal statements is, it goes by operating expenditure OE and development expenditure DE. So the development, all our deficit is completely used to finance the development expenditure.
Mm-hmm.
So those type of controls maybe this type of additional transparency or having administrative controls could sort of give investors the confidence to know that even though this country is in debt or is incurring debt, it is incurring debt to sort of boost future growth.
Okay.
Yeah. So perhaps that's one way I could think of sort of squaring this.
Is there like a institutional requirement for you to have so that the policy of basically the finding of the optimal debt is useful for policy?
Sorry,
Is there some institution, for example, we had the institutional arrangement where we're like, okay, the debt that we have is only for development, right? So many for developing countries, they don't have strong institutions, for example.
yes.
And so for that, the optimal debt policy may not be as informative. I don't know, that's just my hypothesis, right?
Sorry, I also didn't get that.
So, for example, in Malaysia, right, we took up like really high debt in the 80s, right? And we can only do that because we have a rule saying the debt is only for development. Maybe for many developing countries, the debt is for like war, rebellion, or whatever, right? And so, like, maybe they don't have the institutions needed to transfer the debt into development. And so, my question here, not really a question, but a comment, is that probably the debt, optimal debt threshold may be useful for countries that have some institution.
It's useful for countries with the institutional, sufficient institutional sort of quality.
Capacity. Basically.
Yeah. I think that is quite, it's captured in the literature as well. Maybe not so much in our actual working paper, but when I kind of quickly glance through, is like, so we look at things like, weaker public institutions that tend to be perceived as having less control over public finances tend to undermine market confidence, which sort of increases borrowing costs and etc., which then leads to more debt as well. So I do think that for at least for low-income countries, having these type of debt thresholds can be more of a hindrance than a benefit, because then it sort of limits their discourse on what they should be spending on. So it shifts the discussion away from what they should be spending on to you should limit your spending. And whereas for countries like Malaysia, where there's a bit more development and there's institutional quality, the threshold can again act as a soft constraint. And I think that nuance should be appreciated, especially in terms of policy advisory work for international scale. But in terms of Malaysia, as we concern ourselves with Malaysia, for us, when we come to advisory work to our government, we want to think about ways that we can tell the government that this should be a soft constraint for you. Yeah, so I think, thanks for raising a good point for us.
And I have also a comment, it's more like a suggestion. I think it will be nice, especially in this paper that is only focused on Malaysia, that you talk also about other characteristics of public debt in Malaysia as maturity. What share of the debt is issued in domestic currency, in foreign currency? Where is this debt issue, like in the international financial markets, in domestic markets? Because I think this idea of the threshold level, I mean, it's an old literature, and it was when the only thing you carried was the level, because it's what is easy to observe. But I think also now we have much more insights from the literature that is not only about level. You can have, like in Mexico, for example, a crisis in 1994. The debt level was 50%, but was low. The problem is that the maturity was very short. So you cannot roll over the debt if the maturity is very low, because
you default on it.
Exactly. So I think it's important to, I mean, at least for Malaysia, like I haven't seen a good paper that provides this kind of insights on the maturity, who are the debt holders. So I think that that will be a good addition to the paper. And just to follow up your analogy of the car, I mean, it's not the same if you go 100 kilometers per hour in a Chevy or in a Ferrari, right? So that's why it's important to know what car are you driving.
100%. I'm glad that this car analogy is catching on. But 100%, definitely. I think when the IMF comes to visit for Article 4, they do publish their DSA, that sustainability assessment, on a yearly basis, I believe. So they do identify some pockets, but definitely to look more further into these type of things can actually inform, have a more nuanced and also informative discussion about debt, government debt, and the type of risk that it poses.
We have comment from line.
Okay.
So just going to read comment from Pingin. Endogeneity should be addressed in the empirical economic research. You can read the structural threshold regressions developed by Gutierrez et al. 2016, which allow for endogenous threshold variable as well as for indigenous regressors. So that's what it
Does he have access to that comment or?
I think the same comment that he made online as well. Which
Yeah.
I've noted
Otherwise,
down
we
actually.
can send it
Yeah,
to
I've
you.
noted it down as
We
well.
also share.
Thank you so much.
Perfect. So if there is no further questions, let's finish here. Thank you very much. And
All right.
we will be back in January. Please, if you can scan the QR code. And thank you for being here today. Thank you, people online, and see you next year.
With the cover slide.